Today, I'm going to show you how to accurately identify and map market structure along with its key elements. This is one of the most important foundational steps in your trading journey, and mastering it will set you on the path to success and profitability. One of the main reasons traders face losses is their inability to properly map, read, and understand market structure. So in this video, I will break down both the basic and advanced concepts of market structure that are essential for you to grasp and apply. I will also share some powerful tips and techniques for mapping market structure that will give you a significant edge in the market. Make sure to watch the entire video carefully and take notes to fully understand these concepts. And if you find this helpful, please give the video a thumbs up to show your support and subscribe to the channel so you don't miss any future updates. Now that we have set the stage, let's start with the basics. When you open a chart, you will notice that the market is always in one of two states, the trending states. In these states, the market moves in a clear direction. It's either trending upward, which we call an uptrend, or trending downward, which we call a downtrend. You will see the price moving consistently higher or lower, forming a distinct pattern. The consolidation state. This is also known as the choppy or ranging state. Here, the price moves sideways within a specific range, bouncing between a support level, the lower boundary, and a resistance level, the upper boundary. It doesn't break out in either direction, creating a contained pattern. The market constantly circles between these states, uptrends, downtrends, and consolidations. Typically, price consolidates between uptrends and downtrends and vice versa. These consolidation phases are often driven by large institutional players who use them to accumulate liquidity and build positions, setting the stage for the next big move. It's important to avoid trading during consolidation unless you have significant experience, as it carries a higher level of risk. With this understanding, the first thing you should do when you open a chart is to identify whether the market is in an uptrend, downtrend, or consolidation phase. To do this effectively, let's explore how these structures are formed. In an ideal uptrend, observe that price consistently forms higher highs and higher lows. Watch closely to see that price typically breaks the previous highs while holding the lows. An uptrend ends when the price breaks and closes below the last major low to the downside. To maintain the uptrend, observe that price does not break this major low. Also, take note that whenever the price breaks a major high to the upside, it creates a break of structure, BOS, and establishes a demand zone associated with the BOS wave. This demand zone often becomes a key area of interest for future price action. With this foundation established, it's crucial that we know how to accurately identify major highs and lows, as this enables us to dictate signals for trend reversal or continuation in the market. Without proper identification of these pivotal points, we face the risk of falling into traps and trading on the wrong side of the market. The same concept applies to the bearish scenario. In a downtrend, observe that price consistently creates a series of lower lows and lower highs. In this scenario, the price has a tendency to break the previous lows while maintaining the highs. I want to point out that I refer to this type of market structure as ideal rather than realistic, because it's uncommon to find an uptrend in the market that perfectly follows this pattern. In reality, prices rarely move with such simplicity or precision. Shifting gears slightly, let's delve into the details of the realistic market structure. This represents the realistic uptrend structure that is more commonly observed in the market. Let's carefully consider the scenario that played out in the Euro-USD pair, where the price has broken the previous highs to the upside. This critical moment raises an important question: how do we accurately identify valid major highs and lows in the market structure? To answer this question, let's examine this price movement methodically. Here, you can clearly observe that the price moved upward until it began to retrace. This highest point reached before the retracement began is what we define as the major high, the peak of bullish momentum before sellers stepped in. Follow my cursor to see the lowest point of the bullish wave that initiated the upward movement. This point that eventually led to the break of structure and a new high is recognized as the major low. This low marks the beginning of the bullish impulse that carried the price to new heights. These 2 points, the major high and major low, constitute what we call the major external structures of the market. Everything that forms between these 2 points is considered an internal structure. This distinction is crucial for interpreting market behavior. When the price breaks above the major high, it creates what traders call a break of structure. Conversely, if the price drops below the major low, we should interpret this as a potential trend reversal signal, a significant shift in market direction. It's important to note that the specific internal price action within the range of external structures becomes less relevant as long as the price maintains position above the major low. As long as this condition is satisfied, we can confidently consider the market to be in a bullish state. Once identified, these major external structures effectively define our current area of interest and establish the trading range we should focus on. As we observe the price action unfold, we can see that the price has entered a retracement phase, generating a series of internal structures. Following this retracement, the price forms a bullish internal realignment before breaking through the recent major high to the upside. This breakthrough establishes a fresh major high and a new major low. This newly generated major low is the external low situated at the extreme point of the retracement. This particular low gains its major status because it represents the last low created before the price initiated an upward movement that led to the break of structure. You might wonder why we don't consider the other low points as the major low. The rationale is straightforward. The low located at the extreme is the ultimate and lowest point before the price begins its upward journey. This specific low is particularly significant because it marks the precise turning point that triggered the upward movement and subsequently led to the break of structure, making it the foundation of the new bullish phase. Shifting our focus to the bearish scenario within the same trading asset, we can observe that it mirrors the bullish scenario but in reverse. Here, the price initiates a bearish wave, breaking below a major low, which results in a break of structure to the downside. This movement often establishes a supply zone within the BOS wave. In this case, we will highlight a major low that marks the lowest point the price reached after the break of structure. These 2 key elements, the major high and the major low, constitute our external structures, while all price action formed between them is classified as internal structures. Notice that when the price breaks below the major low to the downside, it creates what traders recognize as a break of structure. This signals a continuation of the bearish trend. However, if the price climbs above the major high, we will interpret this as a potential trend reversal signal, a significant shift from bearish to bullish momentum. To simplify this concept, the specific nature of internal price action within the external structures becomes less significant as long as one critical condition is met. The price must remain below the most recent major high. As long as this condition holds true, we can confidently consider the price to be in a bearish state. As we follow the price movement, we can see that it retraced upward, forming a series of internal highs and lows within our established trading range. Despite this upward retracement, we can clearly see that the price eventually reversed direction and broke below the recent major low to the downside. In this scenario, the high located at the extreme point of the retracement becomes our newly generated major high. This particular high gains its major status because it represents the highest internal high created before the price initiated a strong bearish push that resulted in a new break of structure. This extreme high is particularly significant because it marks the precise turning point where buyers lost control and sellers took over, triggering the downward movement that led to the break of structure. This high serves as the ceiling of the new bearish phase, making it a critical reference point for traders monitoring the market structure. With this framework established, we will delve into another crucial aspect of market structure, the break of structure, BOS. You have likely encountered this concept in various trading tutorials, market structure videos, and trading handbooks. While in a bullish structure, BOS is often simply defined as a situation where the price breaks a high to the upside. The reality is more nuanced. There are specific rules and key points we must carefully consider to reach the conclusion that a break of structure is valid. To examine the specifics of these key points and rules in detail, let's examine the bullish move in the Euro-USD chart. Price experienced a bullish momentum that appeared to achieve a break of structure. How do we determine that this BOS is valid? A break of structure is valid when the price not only breaks above the most recent higher high, but also closes above it with the body of a candle. This criterion remains valid even if the price immediately reverses and moves downward after breaking the structure. As you can see, that is what happened in this scenario. Therefore, the price action has generated a new major low and major high, effectively establishing a new trading range. If the price subsequently breaks below this newly generated major low to the downside, this movement indicates a potential trend reversal. This significant shift signals that the price is no longer exhibiting bullish characteristics, marking what traders call a change of character in the market. However, not all breaks above a previous high qualifies as a valid break of structure. For instance, we observe that price breaks the recent higher high with only a long shadow or wick, but the body of the candle promptly closes below the range of the high. This scenario does not constitute a valid BOS. Additionally, we waited for the subsequent candle to close and noticed that each wick fails to surpass the first candle's wick. This indicates that the break of structure is not valid, as the price did not demonstrate sufficient momentum to confirm the move. So therefore, we do not consider this scenario a valid break of structure. In this case, we regard this low formed as merely an internal structure formed within our established trading range. Therefore, to identify a genuine trend reversal signal or a valid change of character in this scenario, we have to patiently wait for the price to break the major low located at this extreme. Make sure you adhere to these specific criteria for identifying valid structural breaks to avoid false signals and develop a more accurate understanding of market structure and potential turning points. This precision in analysis will help you succeed and distinguish you from those who misinterpret market movements. I'm committed to making this channel the absolute best and most resourceful place on the internet for traders like you. Please tell me in the comments exactly what video topics you would like me to cover next. I would love to hear from you, and be sure to hit the like and subscribe button so you never miss any future updates that could transform your trading journey. Now let's consider another important scenario in the market structure analysis. The price breaks the recent higher high with a wick rather than a candle body. But then the body of the first candle closes below the range of the high. In this case, we will need to pay close attention to what happens next. Specifically, after the close of the next candle, we notice that this subsequent candle's wick exceeds the first candle's wick. We can indeed consider this a valid break of structure. This pattern is significant because it shows persistent buying pressure despite the initial failure to close above the previous high. The second attempt to push higher, as evidenced by the longer wick, confirms the bullish momentum. If this scenario appears in your chart, we have identified a valid break of structure. Therefore, in this case, we have established a newly formed major high, the highest point reached by the second candle's wick, and a major low, the low point before the upward movement began, which together define our updated trading range. By understanding these nuanced scenarios and applying these specific criteria, you can more accurately identify valid breaks of structure and avoid being misled by false signals. This precision in analysis allows for better entry and exit points and a clearer understanding of the market's directional bias. Shifting our perspective now, let's briefly break down the bearish scenario, which mirrors the bullish scenario but in reverse. When analyzing a bearish market structure, we apply similar principles but with an opposite perspective. Let's examine this dollar-yen pair in a strong downward movement with heavy momentum. Observe how we identify a valid break of structure during the current impulse move of price. First, we require the price to not only break below the most recent lower low, but also to close below it with the body of a candle. This confirms the strength and validity of the bearish move. This confirmation is crucial for validating the bearish momentum. If the price breaks below the recent lower low with only a long shadow or wick, but the body of the candle promptly closes above the low's range, we must examine what happens next. If the subsequent candle's shadow fails to surpass the first candle's wick, we should not regard this as a valid break of structure. In such cases, to establish a genuine bearish break of structure, we should patiently wait for the price to close below the low's range with the body of a candle. This confirmation provides stronger evidence of bearish control and momentum. On the other hand, if the subsequent candle's wick extends beyond the first candle's wick while still closing above the low's range, then we have identified a valid break of structure. This pattern indicates persistent selling pressure despite the initial failure to close below the previous low. Following this valid bearish break of structure, we need to update our major low, the lowest point reached, and major high, the high point before this downward movement began. As long as the price remains below our newly generated major high, we can confidently consider the market's direction to be bearish, regardless of minor fluctuations within the range. It's important to emphasize that only if the price decisively breaks above the newly formed high to the upside can we consider this a valid trend reversal signal or a major change of character. This break would indicate that sellers have lost control and buyers have taken over, potentially shifting the market from bearish to bullish. Now that we have analyzed various types of scenarios of the break of structure patterns and possessing a solid understanding of what constitutes a valid BOS, let's shift our attention to another crucial factor of market structure mapping: change of character. To identify a valid change of character, you must first determine the general market direction, whether the market is in an uptrend or downtrend. Once established, the next step involves highlighting the valid break of structures on your price charts. To demonstrate this for better understanding, let's examine the GDP-JPY pair. Observe that price is in an uptrend, creating a series of higher highs and higher lows. This resulting low and high represent our latest major structures associated with the first valid bullish BOS. As we have previously discussed, this price action forming between these two structures is considered internal to the market structure. Change of character patterns can be categorized into two distinct types: minor and major. For example, each time the price breaks any of these internal lows, it signifies a minor change of character. However, it's essential to understand that a minor change of character alone cannot be regarded as definitive sign of a shift in the overall market structure. Many novice traders who haven't correctly identified the market structure often misinterpret this minor change of character as a signal of a reversal in market direction. They prematurely conclude that the bullish phase has ended and believe it's an ideal time to enter short positions. Typically, these traders place their stop loss just above internal high. However, contrary to their expectations, the price often makes only a brief retracement before resuming its bullish movement. This results in their stop losses being triggered, leaving them confused about why their position failed. Unfortunately, many repeat this action consistently without understanding the underlying issue. What these traders fail to recognize is a crucial point. The price didn't break this major low to confirm a genuine market structure shift. They shouldn't have entered short position until the price decisively broke the last major low to the downside. The identified change of character was invalid and the price was merely in its retracement phase before continuing in its primary direction. To obtain a valid market structure shift signal, you should patiently wait for the price to establish a major change of character. This occurs when the price breaks and closes below the last major low that initiated the upward movement, leading to the bullish break of structure. Furthermore, it's crucial to always remember that in the bullish scenario as we have here, a change of character pattern is considered valid only when the price breaks and closes below the last major low with the body of a candle. If the price breaks the most recent structure with only a long wick or shadow and closes within the highs range, then the change of character is invalid and we cannot consider it a market structure shift. This same concept applies to bearish scenarios, but in reverse. For a valid change of character that provides high probability trading opportunity, we need the price to break and close above the recent major high with the body of a candle. A mere penetration with a shadow or wick is not acceptable as confirmation. Make sure you understand this nuanced aspect of market structure analysis, particularly the distinction between minor and major changes of character. This can help you avoid common pitfalls and make more informed decisions. This approach helps identify genuine market reversals while avoiding false signals during normal retracements, ultimately leading to more successful trading outcomes. Thank you for taking your time to explore this important market structure concept. By applying these principles consistently, you'll be better equipped to navigate the complexities of price action and identify high probability trading opportunities. That's it, traders. To get more details and ask me personal questions about any area of trading, click on the link in the description to join my free trading club. Also, don't forget to like this video and subscribe to the channel to stay updated on the next video, which will be dropping very soon.